So the KSP rebounded by 0.62% today. But honestly, the real story isn't just that top line number. It's the massive tug of war between tech giants and heavy industry that's happening right beneath the surface. We're looking at a market in the middle of a really profound transformation. On one side, we've got the relentless high-growth engine of the semiconductor industry pushing the index upward. But on the other, we're seeing a fascinating rotation of capital actively seeking out the tangible, physical value of traditional manufacturing. Let's unpack the precise data driving this aggressive market shift in today's explainer and see exactly where the smart money is flowing right now.
That 0.62% jump, yeah, that's not just a random daily blip. It represents a hard, aggressive reversal in market sentiment. We're seeing a powerful upward snap in the index that completely shifted the momentum of the trading day. This kind of sudden, sharp movement is absolutely crucial because it effectively traps anyone who is positioned for a deeper fall, forcing them to cover their positions and inadvertently fueling the rally even further. Beyond the mechanics of short covering, though, this bounce signals a really strong underlying confidence in the broader market. Investors saw a dip, immediately recognized it as a buying opportunity, and completely changed the trajectory of the session. And check out where this pivotal shift actually went down. The market literally hit a floor right at a highly anticipated crucial support level. When the index reached this technical threshold, it didn't just hesitate, it completely absorbed the incoming selling pressure. Instead of breaking down into a deeper correction, it sharply reversed upward. This is a textbook display of technical resilience playing out in real time. It tells us that major institutional players have clearly defined their boundaries. They drew a line in the sand, defended it aggressively, and proved there's massive, mobilized capital ready to step in the second the market gets too close to the edge. Now, if you're wondering why we saw such a decisive bounce, well, look no further than the broader sector data. A massive, unmistakable wave of institutional capital is spreading across the tech sectors, lighting up the data with strong positive inflows. This wasn't some retail speculation rally. The big money stepped in today, and they did it with serious, undeniable volume. We are witnessing large-scale institutional accumulation, where massive funds are systematically building out their positions in key technology assets. And when you see capital deployed at this level of coordination, it's a clear signal of strategic, long-term alignment rather than just a quick day trading maneuver. Anchoring this whole momentum shift is sheer corporate scale. I mean, Samsung's massive footprint was absolutely undeniable in today's rebound. When a titan of this size makes a move, the entire index feels the gravitational pull, providing an immense stabilizing force for the broader market. We're talking about a company whose market capitalization and operational depth literally dictate the pulse of the national economy. Its performance acts as the bedrock for the tech sector's recovery. As major investors reallocated capital into Samsung, it sent a clear, undeniable signal of confidence that resonated outward, lifting smaller suppliers, tech subsidiaries, and eventually the whole index along with it. But to really wrap our heads around the sheer power of this tech rally, we've got to look under the hood, at the hardware itself. The primary force driving the semiconductor sector higher right now is the relentless global demand for next-generation HBM3E memory chips. These aren't just standard components, right? They are the essential critical building blocks for the global artificial intelligence boom. Without high-bandwidth memory, advanced AI processing simply cannot function at scale. These dual forces, the latest cutting-edge architectures scaling up from both Samsung and SK Hynix, are the undisputed engines of today's chip rally. They're capturing the massive capital inflows generated by a worldwide race for AI supremacy. However, right beneath the surface of this broad index rally, there's a totally wild divergence unfolding with SK Hynix. Looking closely at the data, we see completely opposing investment strategies playing out at the exact same time. On one side, foreign investors are actively accumulating shares, aggressively scooping up available supply to build long-term positions. But on the exact opposite side, domestic institutions are actively distributing and offloading their holdings, taking profits or rebalancing their portfolios. Neither side is backing down, which creates a fascinating gridlock in the market. It's incredibly rare to see two massive pools of capital taking such contradictory stances on one of the market's most critical assets. This whole situation is basically a masterclass in market microstructure. We're literally watching massive buying walls from foreign capital smash directly into heavy selling walls erected by domestic institutions. For anyone tracking market momentum, this is a pure impartial display of supply meeting demand, establishing a tense, high-stakes equilibrium. Every time a domestic fund tries to push the price down by selling a large block of shares, foreign capital is right there to absorb it, holding the price steady. Understanding this microscopic battle over liquidity is absolutely key, because whichever side eventually exhausts their capital is going to dictate the ultimate direction of this stock for weeks to come. But the market never just sits still. Right as the semiconductor sector peaked today, boom, the data showed a high-speed structural pivot. Capital began to rapidly cycle away from tech, flooding directly into the broader industrial and auto sectors. This is a massive sector rotation unfolding right before our eyes. We're watching billions in institutional wealth effectively change lanes on the highway. Instead of chasing higher valuations in chips, money managers are taking their outsized profits and actively deploying them into a completely different segment of the economy. It's a dynamic shift that really underscores how quickly sentiment can pivot from high-growth tech to traditional manufacturing. Let's actually dive into the auto sector to see how this plays out. You can clearly track the momentum stacking up with these highly anticipated flagship rollouts, like the Ioniq 9 and the Palisade. This heavy metal manufacturing is suddenly capturing all that massive liquidity that tech just left behind. And the reason is pretty clear. Investors are actively seeking tangible physical value. In a market that's sometimes driven by speculative future earnings, these manufacturing giants are providing immediate, measurable results. They're delivering physical products to a global consumer base, generating massive free cash flow, and providing the exact type of defensive stability that large funds crave when they rotate out of volatile tech stocks. And hey, it definitely doesn't stop at just bolting together traditional cars. The auto sector is aggressively pouring its capital into future-facing strategies, specifically funneling resources into artificial intelligence and human-centered robotics. They're taking those massive traditional manufacturing profits and actively using them to fund cutting-edge, next-generation innovation. It's a brilliant hybrid model. By dominating the physical roads today, they're financing the automated, robotic infrastructure of tomorrow. This just proves that investing in traditional manufacturing isn't merely a defensive plan anymore. It's practically a backdoor entry into some of the most advanced, futuristic technology being developed on the planet. So this fluid movement of capital from tech over to foundational heavy industry, this is the real lifeblood of a healthy, functioning market. It prevents dangerous bubbles from forming in any single isolated sector. By rapidly reallocating massive tech profits into heavy manufacturing, the market actively seeks out new stabilized value. Think about it. If capital just stayed in one place forever, the market would become incredibly fragile and prone to devastating crashes. Instead, this continuous rotation acts as an economic shock absorber. It ensures liquidity is constantly distributed across different industries, keeping the broader index resilient and providing diverse opportunities for investors who know exactly where to look. Taking it a step further, we're seeing this industrial strength bleed right over into the defense sector. The sheer scale and operational capacity of systems like the K9 artillery illustrate this perfectly. Driven by massive ongoing global geopolitical shifts, this is industrial capability that is currently absorbing institutional liquidity like a sponge. As international tensions force governments worldwide to completely rethink their security infrastructure, Korean defense contractors are stepping right in to fill the void. This isn't just a short-term trend, it's a multi-year structural shift in global defense spending. The capital flowing into these heavy-duty manufacturing lines today reflects a really deep institutional belief in the long-term profitability of the sector. Taking our explainer offshore for a second, this manufacturing momentum just keeps accelerating. Commercial shipbuilding, specifically the construction of these massive global feeder vessels, plays a critical and ongoing role in supporting the broader KSPI index. It's a colossal pillar of heavy industry catching a major bid today, which strongly signals investor confidence in the long-term recovery of global trade. I mean, these ships are the literal arteries of international commerce. When order books for these vessels start filling up and capital flows into the shipyards, it tells us the market anticipates sustained, robust demand for the physical movement of goods across oceans over the next several years. And this industrial stacking effect, it just keeps snowballing. We're tracking these vast, incredibly complex maritime construction operations across the country. This level of infrastructure build-out requires immense amounts of capital, millions of tons of raw steel, and highly skilled labor, which further anchors the broader market rotation into tangible, physical assets. Projects of this scale don't just benefit the primary contractor. They create a massive economic ripple effect. They stimulate demand for raw materials, logistics, and secondary engineering services. This cascading flow of capital ensures that the rotation into heavy industry touches almost every corner of the foundational economy. Now, tying all of this massive industrial muscle together is energy infrastructure. Producing and deploying a 380 megawatt class gas turbine is a feat of breathtaking engineering scale, and it perfectly visualizes the colossal, physical capital flows sweeping through the market today. Power generation is the absolute prerequisite for everything we've talked about so far. You just cannot run advanced AI semiconductor fabs, massive automated auto plants, or heavy shipbuilding operations without a massive, ultra-reliable power grid.
As capital floods into these heavy industries, it simultaneously mandates a massive upgrade in energy infrastructure, creating yet another highly profitable sector that is currently capturing the attention of major institutional players. All right, let's zoom all the way out to the macro level down at the Busan port. These staggering, basically endless export volumes are the ultimate fundamental driver of Korea's KOSPI index. Every next-generation semiconductor, every flagship vehicle rolling off the line, and every massive gas turbine eventually translates into these shipping containers moving across the globe. This is where all that complex data, the sector rotations, and the market microstructures become totally physical. The sheer velocity of these containers leaving the port is the most authentic, undeniable metric of economic health we have. It proves that the market's industrial rotation is backed by real, tangible global demand.
To bring this whole explainer full circle, all of this macro industrial output, from the sprawling shipyards down to the microscopic, hyper-advanced semiconductor fabs, it all funnels its profits and data right back here to the institutional financial hub in Seoul. This is the epicenter where the capital from global exports is collected, analyzed, and fundamentally repriced. It's here that the order books will open up tomorrow to process this massive influx of data all over again, matching buyers and sellers based on everything we've unpacked today. The daily setup is complete, the data has been absorbed, and the market has firmly established its new structural foundation.
So, the ultimate question remains. With capital now fluidly bouncing between high-growth, next-gen AI chips and defensive, heavy metal manufacturing, which sector is going to dictate the market's long-term trend? Think about where your own portfolio is positioned and whether you are aligned with the physical world, the digital future, or a calculated mix of both. If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.